Welcome to the EU Economics Brief for the week ending July 12, 2025. This week, the spotlight is on sweeping new US tariffs targeting European goods. Tensions between the US and EU have escalated, with Washington announcing 30% tariffs on a broad range of European exports. We'll break down what this means for European manufacturers, consumers, and the broader economy, starting with the main story. The economic news cycle in Europe was dominated this week by a major announcement from Washington. On July 10, 2025, US President Donald Trump unveiled sweeping new tariffs of 30% on a broad array of goods manufactured in the European Union. The affected sectors include vehicles, machinery, chemicals, and a range of industrial components. The new tariffs are the harshest so far in the ongoing US-EU trade tensions. European exporters, who have long relied on access to the American market, now face immediate cost increases and uncertainty. The policy marks a substantial escalation, raising concerns about the future of transatlantic trade relations. This will hit the German Mittelstand hardest, said EU/Trade Policy Watcher, referencing the backbone of Germany's manufacturing sector, small and medium-sized enterprises deeply integrated into global supply chains. Analysts note that many of these businesses operate on thin margins, making them especially vulnerable to new trade barriers. EU officials are expected to respond in kind, but the scale of the new tariffs, higher than most experts anticipated, has left many scrambling to assess the broader economic fallout. The US tariffs' immediate impact is felt most acutely in Germany, the EU's largest economy. Germany is home to major car makers, machinery suppliers, and chemical producers, now facing new costs when selling to the US. Germany's Mittelstand companies are on the front lines, critical to the country's export strength. Many invested heavily in transatlantic supply chains, now under threat. Trade analysts say the automotive sector is particularly exposed. German car makers exported over $25 billion worth of vehicles to the US last year. Now, with a 30% tariff, that trade becomes significantly less competitive. Machinery faces similar headwinds, with some firms already warning of slowdowns. Manufacturers across the region had contingency plans, but few anticipated the scale and speed of the US move. Industry experts warn that new tariffs could cause widespread supply chain disruptions. Many European manufacturers rely on integrated, just-in-time systems. Any increase in trade friction risks delays and higher costs. This will hit the German Mittelstand hardest, reiterated EU/Trade Policy Watcher. These small and mid-sized firms often lack the financial reserves of larger multinationals, making them less able to absorb sudden shocks. Analysts also caution that retaliation from the EU is likely, potentially triggering a trade war. These new measures increase the risk of slower growth for European industry. Amid the turbulence in trade, Europe received a boost from the resources sector. Sibanye Stillwater, a leading South African mining company, announced a multi-billion euro investment into European lithium and green metals projects this week. The investment is aimed squarely at supporting Europe's battery transition and the broader green technology value chain. Sibanye Stillwater's move is seen as a vote of confidence in Europe's raw materials strategy. The company will focus on developing lithium resources, recycling facilities, and new supply lines for metals crucial to electric vehicles and renewable energy storage. This aligns with the EU's push for greater autonomy in sourcing critical minerals. This shows Europe's raw materials strategy is working, said EU's Critical Minerals EU. The EU has spent years crafting policies to secure the supply of essential inputs for its green transition, reducing dependence on overseas suppliers. The investment also highlights a growing recognition among policymakers and industry that supply security is now a top priority. Supply security is finally becoming a priority, added UEV supply chain, capturing the shift in mindset as Europe races to build resilient green tech supply chains. Sibanye Stillwater's commitment is expected to have far-reaching implications for Europe's green technology ambitions. By investing directly in European resources, the company is helping to create a more robust and autonomous supply chain for batteries, electric vehicles, and renewable energy infrastructure. The EU has made raw material independence a cornerstone of its industrial policy, especially as global competition for critical inputs intensifies. With demand for green metals like lithium, nickel, and cobalt rising rapidly, local supply is crucial for meeting climate goals and supporting high-tech industries. Industry observers see the Sibanye Stillwater deal as a sign that Europe's long-term efforts are bearing fruit. This shows Europe's raw materials strategy is working. Critical minerals EU emphasized. The deal also brings new jobs, investment, and technological innovation to regions hosting these projects. As geopolitical risks mount and the energy transition accelerates, supply security is no longer a secondary concern. Supply security is finally becoming a priority, said EV supply chain, underlining the urgent need for stable domestic sourcing of key resources. Eurostat released new inflation data this week, showing that Eurozone inflation fell to 2.5% in June 2025. This is the lowest level in almost 3 years, marking a notable cooling of price pressures that have troubled households and policymakers alike. While the headline number suggests some relief, the story for consumers remains mixed. Many families continue to feel squeezed by high prices, especially for essentials like food, housing, and energy. Lower prices, but the consumer still feels squeezed, said Price Pressure EU, reflecting widespread sentiment on the ground. Retailers report that while some costs are stabilizing, consumer demand is still subdued, with many households cautious about spending. Wage growth in several countries has not kept pace with past inflation, meaning purchasing power remains under strain. For the European Central Bank, the latest figures offer cautious optimism. However, the persistent sense of financial stress among consumers keeps the pressure on policymakers to balance inflation control with support for economic growth. Turning east, Russia's latest official GDP data show growth of just 1.4% in the first quarter of 2025. Many sectors, including manufacturing and retail, are now in contraction, a sign of growing economic challenges facing the country. Despite the reported growth, skepticism remains widespread, both among analysts and within the broader economic community. Isn't growth much more likely negative already? Asked Vegetable River 253, echoing doubts about the reliability of the official Russian statistics. Several independent economists suggest that the real picture may be one of stagnation or even outright recession. Structural issues, ongoing sanctions, and weak consumer spending are all weighing on Russia's outlook. The divergence between official numbers and on-the-ground realities has become a focal point for international observers tracking the region's economic trajectory. For Europe, Russia's economic struggles have implications for energy markets, trade flows, and the broader geopolitical context. The latest business activity data from the Eurozone add another layer of complexity to the economic picture. The June 2025 Purchasing Managers' Index, or PMI, shows that overall business activity has stalled, with readings hovering around the 50-point mark, indicating neither expansion nor contraction. This stagnation comes even as inflation pressures persist, placing the European Central Bank in a difficult position. Stagnation plus inflation stalls outlook, summarized Euro Outlook. The data highlight a fragile recovery, with business leaders expressing caution about future investment and hiring. Manufacturing sentiment remains weak, especially in sectors exposed to trade uncertainty and energy costs. Service industries are faring somewhat better, but overall momentum is subdued. The combination of muted growth and lingering price pressures is fueling debate within the ECB about the right monetary policy response. As policymakers weigh their options, the business outlook for the second half of 2025 remains uncertain. From escalating US tariffs to new investments in critical raw materials, the European economy is navigating a period of rapid change and heightened uncertainty. Policy decisions and market responses in the coming weeks will shape the region's trajectory well into the future. The easing of inflation offers some respite, but consumer confidence remains fragile. Meanwhile, business activity has stalled and external risks, from Russia's uncertain growth to global trade tensions, continue to cloud the outlook. The EU's commitment to securing green tech supply chains is a bright spot, signaling determination to build resilience for the challenges ahead. For ongoing analysis and community discussion, join the conversation at https://www.reddit.com/r/EU_economics/. Europe's next chapter is being written now, and every voice matters.